Good morning, everybody. I hope everyone is having a great morning. My name is Sam Kuhn. I'm joined by my colleagues, Liz Anderson and Julius Probst.
Hello, everyone.
Hi, everybody.
So thank you again for joining us, and sorry for the small change of format. We're just trying new things, dealing with technology issues. But today I'm excited to talk about the U.S. labor market and the latest jobs numbers.
Yeah.
So I guess let's just dive right in. So in this January, bringing in the new year, the U.S. labor market added 353,000 new jobs. So in terms of headline numbers, that is very strong. To sort of urge caution about, because this has happened to me before, is this happened last January where we saw that the initial estimate for the non-farm payrolls numbers was extremely high. It was, I think, in the 500,000 range. Obviously this is robust employment growth. However, there are some statistical quirks based on how the Bureau of Labor Statistics sort of calculates all this data that oftentimes overinflates the January numbers. I just want to sort of preface that, right? But overall, broad-based, demand still outstrips supply. There are more people looking to hire workers than there are workers available, and the labor market is still very healthy. Now, Julius, you just wrote a piece recently about how in 2023, there were a lot of downward revisions for the non-farm payroll numbers. However, we just saw actually the opposite just happen, right? A lot of positive upward revisions. Do you have any thoughts you'd like to share about that?
Yeah, definitely. So to be honest, the piece I wrote about 2 weeks ago became a little bit obsolete. That can sometimes happen. So last year, we saw that most revisions to the non-farm payroll numbers were actually negative, and that tends to happen in a slowing economy. However, with this jobs report, the BLS revised the numbers for the entire year for every single NFP number of last year. And now the revisions for November and December, and also a couple of revisions for last summer, were actually positive. So the story about negative revisions doesn't really hold up anymore, and suggests kind of a stronger labor market than I expected.
Right. And I know you're going to talk about this later, but I'm sort of top of mind. Do you think this concerns Jerome Powell and the Federal Reserve that the labor market is actually too hot? They just decided on Wednesday, to keep their monetary policy fixed, right? Flat. Do you think that in the March decision, that can also potentially have some changes there as well?
Oh, yeah, definitely. The Fed is going to watch the data we are discussing now, high employment growth, wages, etc. So it will definitely have an impact on their decisions.
Thank you, Julius. So moving on and talking sort of about the long-term unemployment in the U.S. labor market. So now this is 26 consecutive months of the unemployment rate below 4%. Something to think about is that in this year, we're 9 months away from hitting the 1953 previous record, right? At 35 months, we're still a bit far away from that 1970 record. Mm-hmm. Do you think, Liz, that we can hit it this year?
Oh, I'm going to be waiting with bated breath.
Yeah, so. I think this is a real potential. I don't really see any sort of major signs that the U.S. labor market is slowing down. Mark Zandi, an economist at Moody's, was discussing this, and really there's two risks that could slow down the U.S. economy based on sort of things outside of just underlying growth, right? It's geopolitical risk. It's sort of things going on with international shipping and trade and other things that really are not in control of the underlying growth. Sort of this very economisty thing called endogenous growth versus exogenous growth. Mm-hmm. Just again, I just want to preface it and say everything the underlying growth in the labor market is still very strong.
It almost seems like the biggest risk to the economy overall is that the labor market will remain too hot for the Fed to bring down interest rates and possibly see a resurgence in inflation.
Right. And I'm sure Julius will share some thoughts
on
this, our Fed maestro, as I like to call him. So moving on and talking about labor supply, right? We just talked about sort of labor demand, the hiring of workers, and then what's on the supply side about people looking to enter the labor force. So over the past few months, we've saw some potentially, I guess, yellowish, I would say, signs about labor force, particularly the prime age labor force, those 25 to 54. We saw some consecutive months of declines, meaning that we were perhaps losing that core group of workers. However, we did see a small increase. It was just enough to make sure that it sort of reassure us that things weren't going to enter that sort of red territory where we were really starting to get concerned about labor supply. And if we look at the next chart as well, again, same thing for prime age employment, the share of people 25 to 54 that are employed, that also increased as well. So both sort of signs that we're going to continue to watch. I don't want to say that this is a complete reversal of the trends that we saw from really September and October. However, it's something we continuously watch and make sure that we're up to date on the latest numbers. And then I'll sort of shift gears and talk about the job gains by industries. So we've talked a lot about the healthcare industry and how strong it is. And something that was really surprising to me was the job growth that was in the professional and business services. We've seen some pretty substantial declines in the hiring and openings rate for the sector from the job openings and labor turnover survey, the JOLT survey. However, we just saw a really strong 74,000 new jobs in the professional business services industry. There's a lot of different sort of third-party data that tracks layoffs, like the Challenger Gray data, which potentially has shown some softening, some increases in layoffs in this industry. However, according to the BLS, the numbers are actually quite robust. And as we sort of look down the chain rung, we see healthcare still doing very strong, retail trade, but then again, we've talked a lot about this as well. The warehousing and storage and transportation industries are truly struggling. And I'm sure, Liz, you can share some insights when we talk about the recruiting data. This is truly reflected in the demand for workers from both a government statistics standpoint, but then also our own Appcast recruitment data.
Yeah.
So moving on, I just want to end with talking a bit about wage growth. So we did see I would consider a significant increase in wages, 0.6% in average hourly earnings. This potentially could cause some worries for the Fed and Jerome Powell. Is wage growth could it actually start to increase again, and then could that actually reignite inflation? We've really started to see some significant declines in personal consumption expenditures and the consumer price index, both different measures of inflation that the Fed watches very closely. Could these wage gains potentially sort of reignite that discussion about a wage price spiral? I'm sure our colleague Julius Probst will mention that. So I'll hand it over to you.
Yeah, so let me talk a little bit about monetary policy and interest rates. This is important because monetary policy will be a big driver of growth and the labor market this year. And so that the Fed's interest rate decisions going forward will have a big impact on the economy, whether we are going to see a slowdown or a soft landing and so on. And so this chart shows financial market expectations over the next 2 years for interest rates. So they're bouncing around a little bit, but what you can see is that as of very recently, financial markets actually expected quite a significant decline in interest rates over the next year. So they are expecting more than 1%, about 1.25% of interest rate cuts over the next year. And that is, in my mind, a little bit of a conflict with the very good economic data that we're seeing right now. Yeah. So if the economy continues to hold up well, if we continue to see strong employment growth, wages have not come down yet, inflation is coming down, but wage growth is relatively strong, then I don't think these 1.25% of interest rates cuts over the next 12 months will happen. And so if you go to the next chart, you can see in this chart that the Fed is also unsure about that as well. And they also don't think right now that interest rate cuts will be so strong. Yeah. So this is the dot plot. This is what the FOMC members think, given economic conditions, where interest rates will be at the end of 2024. And so they think the median FOMC members thinks they'll be much closer to 5, or they'll be closer to 5% instead of 4%. So there's a conflict at the moment between financial markets forecast and what the Federal Reserve thinks itself. Yeah. And so if we go,
Julius. Question for you, Julius. So if I am the, if I'm Jerome Powell and I'm in the FOMC and we're meeting in March again, do you think there's any discussion of rate cuts, or is it going to stay flat? Is it going to stay fixed?
Yeah, I mean, I don't think we'll most likely won't see a rate cut in March, especially since wage growth accelerated. I think that will be a concern to the FOMC, because higher wage growth will ultimately translate into a stickier inflation, especially in the service sector. And so that's something they've been watching they've been watching for, and yeah, so they will leave interest rates unchanged. Yeah. And so if we go to the next chart, it's not just that the labor market is holding up much better than expected, or that wage growth is actually coming in a little bit hotter than expected, but also real GDP growth is exceeding expectations by a lot. Yeah, so last year, the US economy grew by 3%, a little over 3% in real terms, far outperforming any economy in Europe. A lot of European economies have been kind of stagnating. And so this is the GDP nowcast for Q1 of this year. And it currently stands at 4.2%. One thing to keep in mind is that it's in the beginning, it's just the beginning of the quarter. So it might still be a little bit inaccurate, and more data will come in and it will update. But this 4.2% of real GDP growth, this nowcast from the Atlanta Fed, is showing that the economy is actually not slowing down at all. Yeah, so there's like very little data points that would indicate that the Fed should cut in March.
I think we should also, I agree with you, Julius, but we'll see how the next couple of months develop with the data coming in as well.
Very good point. And with that, I think we'll shift gears and talk about the latest recruitment data.
So as you all probably know, we are releasing the 8th annual Appcast benchmark report on Tuesday. So we decided not to focus so much on the overall benchmarks that are shaping the labor market on a whole, but instead dive into a few critical sectors that Sam has already mentioned and that are really important to recruiters in our industry. So we decided to start with critical care nurses and RNs. As you saw from Sam's presentation, the healthcare sector has just been really blowing us away in the past year. The gains have been incredible, and with that, demand has been really high, and it's been a difficult place for recruiters to operate in. The CPAs for registered nurses are at $53. For critical care nurses, it's at $70. These are some of the highest CPAs we see across any sector in the labor market. So it just really dials into how difficult that recruiting market is for the people that are working in it.
Right. And why is that? Well,
apply rates. So as you know, like these roles are really difficult to recruit for. The apply rates for all of them are much lower than our labor market benchmarks on a whole, at just 2.8% for critical care nurses and 2.2% for registered nurses. There's like a modest increase throughout the lows we saw in 2022, but overall, this is still a very difficult sector to recruit in. And you can see from the labor market data that demand is just so high that there's just too many open roles for who can actually fill them.
Right.
So yeah, as Sam mentioned, the warehousing sector has had a difficult couple of years after being like an absolute gem in the post-pandemic recovery, adding jobs at like an insane clip. It's really slowed. I think it peaked in last fall or fall of 20. We'll look at the data later. But as you can see, with that demand falling, the cost per application has also fallen. For the warehousing sector on a whole, it's below $10. It's just at $9.38 now. And although there was a slight peak in the summer month for stockers and order fillers, those have come down as well. Despite even the seasonal rush, we didn't really see any spike for either of these in a period that we would normally expect recruiting to become a bit more difficult.
Yeah.
So then the apply rates for stockers and order fillers have also kind of popped up. We see that as apply rates are directly and inversely related to CPAs. So as you can see, like they went really high for stockers and order fillers, and they're kind of leveling out around 7.3% for the warehouse sector. So yeah, it's getting easier to recruit in these sectors. Also related to warehousing, but not quite, it's the trucking CPAs. For trucking jobs, we also see a real decline in CPAs. They were over 60% for heavy and tractor trailer truck drivers in 2022, and those have come down to just $26. So this is just an easing market for recruiters, and they're finding it a lot easier to recruit. And that's because of apply rates in the sector,
Right.
which have really kind of trended up. They're still low, I mean, compared to industry benchmarks, but I think it's just that demand in the sector has really fallen, and there's less for people to apply to.
Exactly.
Something that Sam mentioned was a little spike in professional and business services, which was in part contributed to by an increase in professional, technical, and scientific jobs. I think they added 42,000 in January. So this, I wouldn't say it's quite a resurgence in technology, despite what my title says. But it is like a slight rebound. I think that technology had a really hard year last year, and now it's becoming a little bit more competitive in the industry. And you can see that from the slight spike in electrical engineers, but really software developers, those CPAs are leveling out. And then, as you can see, the apply rates, CPAs might have fallen because apply rates have really risen for electrical engineers. And maybe that's just like a 1-month spike, and we'll see how that develops. But there is an upward trend there along with software developers.
Right. When you sort of look back and look over the entire period of 2023,
yeah,
I mean, that's a significant increase in
definitely
job seeker activity.
Definitely.
And I think we're sort of reaching a point where, this tech recession is sort of cooled down, right? And then I think 2024 offers a lot of promise for some more robust job gains after.
Yeah, there's definitely a lot of exciting developments happening in tech with AI and everything else. So yeah, I think this will be a sector to watch even after the struggles in 2023.
Great job, Liz. Thank you for those insights. So now we'll actually shift gears, stop talking about the US, and then, talk a little bit about outside our borders, talk about the UK. Julius, what do you got for us?
Sounds good. Yeah, I have 2 charts for you. Just talking about the UK labor market. It does have some relevance for the US as well. So that will be my last slide after this one. So what you can see here is job postings in the UK. On the left-hand side, job postings for white-collar occupations, and on the right-hand side for blue-collar occupations. And so the UK labor market has really been experiencing what I called almost a year ago a white-collar recession. You need to be careful here. The UK labor market hasn't really been shedding too many jobs across white-collar occupations, but job postings have declined significantly. After the boom we saw in 2021 and 2022, in information communication, so for software development, also banking and finance, project management, human resources, the job postings have declined significantly and are now well below pre-pandemic levels. So we're talking about a significant slowdown in hiring, maybe even hiring freezes for some of these, for some companies for these jobs. Blue collar jobs, on the other hand, have been holding up much better. Yeah, so they are still above pre-pandemic levels. And part of the reason here in the UK is with Brexit, there has been less supply of blue-collar workers. And so this white-collar slowdown, blue-collar holding up much better, is especially pronounced in the UK, but it has been happening in quite a few advanced economies. You can see it in Germany, but you can also see it in the US. And so now the next chart will show you kind of like the same thing. This is for the US labor market. Again, left-hand side, white-collar job postings, they surged significantly throughout 2021, 2022. There was a boom in information and communication and other job roles. And so this boom obviously had to end at some point in time. But for some of these jobs, actually job postings are now below pre-pandemic levels. Whereas for blue-collar roles on the right-hand side, job postings are holding up quite well, and they're still above pre-pandemic levels. So it's not as pronounced in the UK, but we do have quite of a slowdown for some white-collar jobs. And we talked last year about the softness of information communication. The sector was shedding jobs for a month at a time. That has been reversing a little bit now, but we are going to watch this. And I think with a very good jobs report over the last 1 or 2 months, maybe this kind of like softness for white-collar jobs is actually reversing in the US now, if not in countries like the UK. But that's to be determined. What do you guys think?
I agree. I think a lot of this also, especially for software development, is a function of monetary policy, right? You could see the peak of demand really right when the rate cycle started to increase, right? And then you can see the significant decline. So if the conversation about rate cuts, it got pushed back potentially a few more months, but I still think that 2024 has a lot to offer for the industries that are so affected by monetary policy. So with that, I'll sort of end, and I want to ask our listeners to just plug some questions in the chat, and we'll respond to you after we're done. But I just want to sort of summarize and take a step back and just think about what all this data means in context. So yes, the U.S. labor market added 353,000 new jobs. That's a good number. The mistake before of thinking that it was too good, right? I would say that we're moving into this beige or stable territory, right? And this is something that we are going to hear a lot about from the recruitment marketing benchmark report that come out on Tuesday. Recruiting costs declining, the U.S. labor market still sort of chugging along, adding jobs, unemployment rate below 4%, GDP growth quite robust. In my opinion, I'm very optimistic and excited about 2024.
Yeah, although the labor market is still strong, it's an easier labor market to recruit in. So I think that's a really good news for most of our listeners here today. So yeah, I agree with you, Sam.
Any parting thoughts, Julius, before we end this?
No, I'd just say that I think not just the labor market, but the economy, the US economy is performing much, much better than most economists expected. It's also outperforming other countries, especially continental Europe. And so even the Fed might be a tiny little bit concerned. All of this is actually very good news for workers and just, for the US in general.
Again, thank you so much for joining us today, and I hope everyone has a great Friday. Goodbye.
Thank you. Bye.